Hey, Damian Mason here with a question before we hop into this episode of the Business of Agriculture. If you farm for a living, you employ a lot of amazing technology, from your inputs that you put into the soil to the tractor that you sit in, your combine, and the amazing data that it harvests. But has your soil analytics kept up technologically with everything else in your farming operation? I would venture to say that no, it is not. Sure, you check for your nitrogen, your phosphorus, your potassium, your micronutrients as well. But what about disease pressure? Do you know what diseases and what pests you're going to face next year? No, you don't. But you can now figure that out with Pattern Ag's predictive analytics. Think about it. They can tell you now with testing what the likelihood of facing nasty diseases, things like cyst nematode or sudden death syndrome, what the likelihood of you having this in your field. Then you know how to prepare, how to treat, and where to invest your money. It's using technology to make you bigger yields and therefore make you bigger money. Go to www.pattern.ag to learn more. They are pioneering the way in predictive agronomy. Well, greetings and welcome to another fantastic episode of the Business of Agriculture. We're talking about farmland today. We're talking about farmland as an investment class. We're talking about where it is in terms of its value. Is it overvalued? Where is the money coming from to pour into this? Is it true that we have a lot of outside money that's coming to rural America and buying up farm ground, preventing some farmer from buying it? Or is that just a whole bunch of coffee shop talk? Also, what are interest rates going to do to this whole thing? And then let's go ahead and admit the reality. Are we at a peak? That and so much more to discuss. Big trends in farmland and all the questions you have, I'm going to ask them for you. I've got Paul Pittman here. Paul is the, I guess I'm going to say, founder of Farmland Partners, an equity company that's now publicly traded, coming into farmland. And I know you're already probably bristling if you're like the average ag person. You're saying, wait a minute, we got these investors coming in. Let's not kid ourselves. This has been happening for a long, long time. It was at least 15 years ago I went to a farm auction. I didn't know anybody there. The people that didn't know me that I was bidding against came up to me and said, are you an investor? And I made the point then, from now on, when I attend a farm auction, when they give out name tags, I'm going to put a name tag on that says investor from Chicago, because every piece of farm ground that's ever been bought in the Midwest since I was a kid, someone said, I don't know who bought it. I heard it was an investor from Chicago. Well, this is not an investor from Chicago, although this guy is from Illinois. He's a graduate of University of Illinois, and he has agricultural background. He now operates a company that invests in farmland. He's going to tell us the story on that and give us some big picture on trends. Paul Pittman, thanks for being here.
Thank you very much, Damian. As you said, I'm Paul Pittman. I'm the chairman and the founder of Farmland Partners. What Farmland Partners is we're a New York Stock Exchange traded real estate investment trust that invests only in farmland. We own about $1.4 billion of farmland across the United States in about 17 different states. We are in virtually every crop, and we are in, and our business model, and the key to our business model is renting to medium and large scale family farmers all across the country.
So you came into this, and there's this, and so we're going to address this a little bit later on. The skepticism that already exists, like, oh, these outside people are coming in here. But again, this has happened to everything. You know, when you're an agricultural person and you invest in publicly traded stocks, you're an outside person there also. This has been going on for a long, long time. You were drawn to it a while back. So a little bit on your background. You are from, obviously, an I state. You do have an agricultural background. Give us that, and then tell us about what drew you to this thing, and then we'll talk about the scaling up of it.
Yeah, I graduated from the University of Illinois in 1985, and my life dream was to be a farmer. But those of you who are my age remember 1985 at the University of Illinois was the very first Farm Aid concert ever. So, I was going to go back to my grandfather's small dairy in Western Illinois, but obviously had that tear-filled conversation with my grandfather that there's just no room for another mouth to feed, so to speak, on the farm. So I luckily had good grades, and I went on to graduate school, first at Harvard for a master's, and then University of Chicago for a law degree, went to Wall Street. But I was, at the end of the day, small town kid dying to be a farmer. So I started taking all the money I made on Wall Street and buying farmland personally. And that's how we ended up a public company. I accumulated about 70 million of farmland, and I contributed all that farmland to Farmland Partners in 2014. And we've grown from 70 million in assets to $1.4 billion over the last 9 years or so. So it's a great story, and happy to address any of these things. I don't frankly feel that we're an outsider at all or changing really the nature of farmland ownership.
So there's different stats you read all the time about the amount of farmland that is owned, and it depends on the different states, but farmland that's owned by the operator, farmland that's owned by the non-operator. And I've been saying this for a long while. Before we had this run up in values, we're going to have consolidation that's been going on since the 1930s of farmers, economies of scale, equipment, automation, innovation, et cetera. And then with that consolidation comes outside investors to own the land, because if you're going to farm 10,000 acres, it's unlikely that you're going to be able to own all of it. This has been going on and growing this direction for a while, since the day you were at University of Illinois, or the day I was at Purdue. I'm 7 years younger than you. And by the way, you don't want to pull that walking uphill to school both ways in a blizzard thing. But if you made it through the 80s and you were observant, you saw a lot of really nasty stuff where you almost can't explain it to the young kids. Like, I hope we never see it again, right?
Cash is king. Cash is king. You go bankrupt because you don't have liquidity. That's what I saw, and that's what I learned, because I had several uncles who had difficult financial times in that era.
Yep.
But to your, to this point of, first, institutional ownership defined, let's define it as broadly as possible. The, Warren Buffett family, the Bill Gates family, the Mormon Church, Manulife, which has the old Hancock Ag Investment Group, Westchester, which is now a part of TIAA, us, a couple of our competitors with $1 billion of assets or more. That is probably 2 to 3% of farmland in the United States, at most 5%.
Yeah. And that's I think that's a big one right there, is that, and you're talking about, again, in the 80s, I read about the Mormon Church owning vast amounts of farm ground. And then you talk about the Warren Buffett and his son that own, hundreds of thousands of acres, right? And even if you put the 10 big institutional investor groups that own farm ground in there, it's single-digit percentage of the farmland in the United States.
Absolutely. And the other important fact, because I looked back at this, I forget where I gave a presentation on this, but the amount of farmer ownership versus investor ownership of all types, whether it's the local dentist or the local car dealer owner or somebody with a company like ours, that hasn't really changed in something like 60 or 70 years. Now, what is changing is there's a gradual increase in institutional owners amongst investors, and a few less of the doctors, dentists, and lawyers from Chicago. Mm-hmm. But when you think about kind of policy issues from the standpoint of small town America and farmland, I'm not sure that matters. And I frankly think you can make a pretty good argument that the long-term, high-quality institutional investor is probably a better steward of the land. We're in this for the long haul. We aren't shy about tiling a farm or improving soil health or investing in grain bins or new irrigation units or whatever the need is, because we look at it just as a long-term financial return. And I'll give you a real-world example.
Real quickly, just to clarify, when you spoke there, you said you believe, without being critical, that you're an institutional investor like you with 196,000 acres is a better steward of the real estate than, and you were not saying then of me, the farm kid, you meant of the dentist from Chicago whose buddies at the country club said, you know what you ought to do? You ought to go downstate and buy 80 acres. Is that what you're talking about?
Yeah, we're at least as good, and I would argue probably better for simple reasons. These institutions, the competitive institutions with us, ours, they're full of people with land-grant university ag degrees who really understand soil health and fundamental agronomic issues and world's supply and demand issues.
Right.
Plus, they are long-term pools of capital that want to gradually maintain and improve land. where I was going with this is I think of your theoretical 75 or 80-year-old widow who owns farmland, and there are many who do.
Yeah, right.
You ask her to tile a farm with a 35 or 40-year payback, and she's already 80.
Yeah.
What is her answer? No.
Absolutely.
It's always no. Okay. And it's not because she's crazy. She's right. But we do it because we have this longer term view and we're an institutional pool of capital.
Yeah, I like that. Again, it's kind of like, all right, we're going to own whatever it is. We're going to own silver mines for the next 20 years. We're going to own office buildings for the next 20 years. The companies that are the REITs that own office buildings don't say, hey, in the next couple of years, this building's going to fall to shit. But that's okay because we're about to die. So that's exactly what you're talking about.
That's right. That's exactly right.
You forgot the other one, Paul, that there's another reason that the 80-year-old widow in Iowa doesn't put in the drainage tile. She has 3 kids, and one of them she's already financially supporting. One of them actually is the farm person that wants something to happen, and the other one is skeptical of any investment that might cut into that one's inheritance. So that's the other reason they don't do it.
No, you're absolutely right. I mean, these are real life stories. And look, what institutional investors are, we're not driving the market. You politely called it coffee shop talk. I would probably have been slightly more harsh. The institutional investor is almost never the top bidder at one of these I-state auctions. I mean, we monitor or attend literally hundreds of auctions a year. Most of our competitors do similar amount of activity. We, in fact, our company owns an auction division. We auction farms where we're not involved in them at all. And the top bidders are almost always farmers. It's 2 neighbors competing aggressively. And it's not because they're wrong, right? A farmer needs that farm in a 10-mile radius of home or a 20-mile radius of home. Right. And he's trying to bring his son or his daughter back into the business. He's got the operating return and the land return to justify price. We as an investor only have the land return. It is completely appropriate. When the chips are down, the farmer should always be able to outbid the investor. That's a good thing. What these large pools of capital that are investors like us do for the market, though, is we put in a floor. And you can actually see this happen. Iowa, where institutions are generally prevented from investing, and Illinois, where we are not prevented from investing, the Illinois land market is much more stable on the downside than the Iowa land market. You can just see this statistically. And that's because people like me, there is a price where we're always buyers.
Yeah. I think that's a really interesting point. First off, I want to talk about the floor before we get into that. The part about Iowa, almost you being precluded from that, is what is happening there? Because I guess I'm not familiar. You're saying that.
Yeah. So there are 7 or 8 states in the country where corporate ownership of you can still have a little family corporation with you and your brother and buy farmland, but a corporation in the way we all think about it with hundreds of shareholders are largely prohibited from owning farmland in several of the Midwestern states, tend to be the northern part of the Midwest and the plains. 3 of the states with the sort of most onerous rules and not really much work around happen to be North Dakota, Iowa, and Minnesota. My perspective on that is that those laws are improper, and here's why. So in Iowa, Bill Gates can buy all the farmland he wants. Warren Buffett can buy all the farmland he wants. The Mormon Church can buy all the farmland they want. But I can't pool the pension funds of firemen and school teachers and buy farmland at all. Tell me why that's fair.
Yeah, it seems like it was a rule set up to appeal to the rural class, saying, hey, you know what? We're not going to have a bunch of big money corporations coming and doing this. And as you just said, well, what the hell is Bill Gates if not an out-of-state big money corporation? It's just that he's not using other investors' money per se. He's not, like you said, he's not pooling. Me and a dozen of my friends say, you know what? We've got $100,000 to throw at something, and we are ag people. You can't do that for us, but he can do that.
Yeah, I mean, I just think it's unfair the way that it's organized. But look, I don't have the energy to battle every battle. So what we've done is we've just taken the amount of money that would have been invested in Iowa farmland and put it in Illinois farmland instead.
I got a couple of things. We'll go ahead and talk about the Bill Gates thing, and I want to get into that, but also I want to talk to you about values. Before I do that, I want to remind you, if you're listening to this episode of the Business of Agriculture, when you are looking at the future of farmland ownership, one of the things that's going to impact you is ecosystem marketing. There's a tremendous amount of environmental pressure that's coming down the pike, whether it's regulatory, for this USDA, new farm bill that's being debated right now, or even what's happening at state level. These things are real. And so the best you can do is position yourself to make money off of what is the new term, ecosystem marketing. My friends over at Truterra are all about that. Truterra is focused on supporting farmers at every stage of the sustainability journey to help plan, maintain, and work on your regenerative management practices. It could be cover cropping. It could be a carbon sequestration program. And the new thing is nitrogen. Companies are paying money. Companies that sell consumer goods at Walgreens are paying money to say, look, we are reducing our carbon footprint, and we can do so through farm ground like you own. So if you're interested in participating in ecosystem marketing, learn more about it. I don't mind if you're skeptical. I was too. I still kind of am, to be honest with you. But I'm seeing what's happening. It looks like it's another revenue source for you and your acres. So go to TruterraAg.com. Truterra, Truterra, TruterraAg.com to learn more about how you can profit. It's a new revenue source, and it's about ecosystem marketing on your farm. All right, Mr. Pittman, you said about Bill Gates. I was going to get there. I'm a little skeptical. What the hell is he doing out here? Just between you and me. What the hell? I get you. I get you. Like you said, you've got a small pension fund, or even you just got a group of, my example before, a group of a dozen people like me said, yeah, I want to invest, but right now I'm too busy working my business. Boom. I don't invest in Farmland Partners. What's he doing?
Yeah. So look, when you look at the wealthy, the ultra high net worth investment in farmland, and Bill Gates is only one of them. Number one, I frankly think they are pretty good stewards of the land. I mean, the Gates organization has hired a group of very reputable, very long-term experienced farm managers and investors. And I don't think they're running that pool of land any differently than I frankly would run it, meaning they're looking for high quality ag land, high quality family farmer tenants. We've bought and sold assets from that organization, and I can tell you on the particular farm we bought, that's how they ran it. I don't know what the long-term agenda is. I obviously don't have any personal relationship with Mr. Gates, but I think that this fear and criticism based on what I've seen is misplaced. I really do. I think certainly the same is true of the Buffett family, who owns an immense amount of land in Illinois and Iowa. They're good long-term investors. I think that what people should really take away from that is that some of the smartest money on the planet thinks farmland's a good investment. I mean, that's the lesson you should take from that.
I'm all about the Buffett and the other organizations. The Gates, when Gates starts talking about we need a regulatory situation to control what people can eat for the good of the environment while he's flying off to Davos in one of his 4 private jets, I'm a little more skeptical of his more sinister motives long term, not necessarily about farm.
Well, look, it makes me nervous too. What I'm telling you, though, is from what I've seen on the ground.
Yep.
They're not that message that you just expressed isn't flowing through onto the actual performance of what they're doing on the farms.
Sure. So you came into this for a bunch of reasons, and you got an investor background. Certainly you rub elbows with these people, Wall Street kind of money. It seems a little, it's hot right now, but when you got into it, there's nothing sexy about farmland. Hell, it stagnated. Well, it dropped obviously through the entire 80s and into the early 90s, and then it just stagnated. And there it sat as an asset class. And that's about when probably you were starting. So tell me about when you started and how you even convinced yourself, let alone other investors, this is somewhere you should be, because farmland didn't move in value after its big, huge plummet for 15 years, 10 years. Kind of take me through some of that. You're a couple years older than me, after all.
Yeah. So look, when you invest in farmland, You should have realistic expectations. And here in today's world are what I think those expectations should be. Your realistic expectation should be a current yield. I'm using the I states as an example. It's a little different in other places. But in the I states, your expectation should be a 2.5% to 3% return on your money after you pay your property taxes.
2.5
that's
to 3.
hard.
Two and a half to 3 net.
Net, that's current yield, and 5% per annum appreciation. That's what you should be looking for. And
2.5 to 3% net, 5% annual appreciation.
And so let me give you data to back that up for a minute. The 2 to 3% is pretty simple to back up. That's just what the cap rates based on the cash rent you can get on a farm that would sell a high quality farm in Illinois, Iowa, Indiana. Now turning to the appreciation. 1970s to present, according to USDA data, 5.5% annual appreciation compounded through that long period of time. There is only one section of time when it went truly negative for year after year, and you alluded to that. It's sort of the mid 80s. It was a kind of the downturn was really 3 or 4 years long. We think of the 80s as all terrible, but the real crash was 3 or 4 years long. What's important here is about what I just said, this is never hot. Do not invest in this thinking that it's hot. So these big numbers you've seen in appreciation in Illinois and Iowa and Indiana in the last 3 years followed nearly 5 years of more or less flat price, maybe even slightly down price.
Right.
And that's the nature of this market. This market doesn't peak in the normal sense of the word. In my lifetime, that's only happened once, and that was in the 1980s. It went up really high and then it went down hard. Every other cycle, both before and after the 80s, clear back to the Depression, that was also a down hard era, has been what I call a surge and then a plateau, and then a surge and a plateau. That's what this market does, but it's over time. If you're a long-term investor, 5, 7, 10 years or more, you're going to get that 5-ish% appreciation on the asset. That is incredibly powerful.
So what we're seeing right now is we've had a huge run up, and that's pretty much everywhere. I'm more familiar with what happens in my little sandbox, of course, northern Indiana, but I'm pretty familiar with other places. I travel around the country like you do. And are we ready to plateau? Have we had our huge run and we're going to plateau now for 3 years? I think we're going to plateau here for a little while. That would be my opinion. We've, depending on how you look at the data, and I can completely geek out on data. We've had really solid 15% plus kind of appreciation, 2020, late 2020, 21, 22, early 23. I think it's time for a pause, right? This is a return to the mean is a concept because it actually makes sense. We know this long-term average is 5.5. So if it goes to 0 for 3 or 4 years in a row, you ought to know there's a time coming when it's going to go back up faster. Alternatively, and it's running 15% a year for a while, we're going to slow down. And I think, and look, at the end of the day, farmland value is driven by farmer purchasing power. Farmer purchasing power is high when the farm economy is really cranking, good yields, high prices, manageable input cost. The farmers have had a lot of cash in their pocket, and they've driven this market up, not the investors, the farmers. And now farmers they're making good money, but we're kind of coming off the edge a little bit. The input costs have come up, interest rates have come up. It's not quite as easy as it was 24 months ago. Do we have 10% of give in the market?
You mean a potential for a downside of 10%? My sense is, depends how you think about it, right? The market is not the $20,000 or $25,000, $22,000 price you saw for a CSR 96 farm in Iowa. That's not the market. That's what makes the headlines. The market, in my opinion, is if you go to a public auction, when are there still 5 bidders? If there's still 5 bidders, that's the market. That market's like 18,000 in that Iowa example I just gave. And
Yeah,
so
it might be 30% less than that where you are, or what, yeah.
Yeah,
So
yeah, whatever
I
it
get you
is.
there.
But that 5% point, what's really so important about that is that where there's 4 or 5 bidders, that means you could show up tomorrow with another farm and somebody's still going to bid at that price. Because the guy that paid 20, these are families. They're only going to buy one farm a year, probably, or one farm every 2
one every
years.
5 years. Yeah, one every 10 years. Yeah, there's still 4 other people. There's still 4 other people that were sitting there saying, well, crap, I didn't get to buy that one.
I didn't get that one. I'm still bidding on the next one.
Yeah.
So that's the way you really, I mean, that's why we monitor so many auctions, is when we see where that real, you know how it always dies down at the end and it's just 2 guys. That's not the market. It was when there were still 3, 4, 5 guys, because you can sell another farm at that price again tomorrow.
Yeah, I think
so. I don't think you have 10% down from that number, whatever that is in your market. I don't think you got a 10. I think you might have 5% down, but I don't think you have 10.
That's very interesting. You've got investors, and you spoke to the idea it might be a pension fund or whatever. So you started Farmland Partners with your assets. So you're obviously you're an investor in your own REIT. Who else is an investor? And I don't mean their names. Tell me what an investor in Farmland Partners looks like. Because, I know what the people are around me that own farmland, inherited, guy and wife with good jobs that are from the farm and then own it. Maybe dad rents, farms it, whatever. I'm just going through these different scenarios. This is a different kind of thing. Who's the owner for you?
Yeah, so the owners for us are really about 50% individual investors and about 50% large institutions. So first, on the large institutions, this is going to be the large index funds have a large position in us. We're in a bunch of the indexes today, so Fidelity, BlackRock, so on and so forth will have relatively large stakes in us based on their index investing model. We also have, several big actively managed funds in our, in us as well.
And those are the kind of funds, Paul, that they say, okay, if you are an investor in our fund, we are going to go and find other places, and one of the places we put it is in farmland. And then we also own medical office building companies.
Of course, they're active asset managers, and they're placing financial bets on companies they believe in and assets they believe in. And then on the individual investor, some of them are farmers and really knowledgeable about farmland values, and they see they buy our stock when they think the stock is low, but the farmland values are high. But most of our individual investors are people who grasp the long-term story in ag, and it's defined by 2 concepts. Fundamental food demand growth gradually keeps increasing, and high-quality farmland is scarce. And that's the long-term story. That's all there is to it. They get that concept, but unlike you and I, they don't have an ag degree. They, lived in New Jersey their whole life. And, they go to their connection to ag is the grocery store. They have no idea, even if they have the money, how to go out and buy a farm. Yeah. And what we do is we've put this investment in a wrapper they clearly understand. Yeah. Call up their stockbroker buys our stock, go online and buy our stock today.
Yeah, I like it. That's a very good thing. Do you think this grows? Because I think it grows. I think that a model like yours, and I mean, your model obviously is going to grow. I assume that you assume you're going to be double the size you are now 5 years from now. And I'm not talking about just appreciation in value on the asset. I mean, money coming in. Is this something that's now an acceptable asset class for anybody? Like you said, the person in New Jersey that says, hey, you know what? I think this is where we need to be in the future. Is that going to happen?
Yeah, I do think that you will see aggregated pools of capital, whether public or private, gradually grow over time with more investor interest. Remember, if you really understand ag, Damian, if you went back and look at the demographics of our ancestors leaving the farm, that big surge occurred with mechanization in the 60s, 70s era. That's when real consolidations amongst farmers really started to happen. Okay. Those children of those parents who were farmers know a lot about farms. Maybe even the grandkids know quite a bit about farms because they went back and spent summers at grandma and grandma.
And those people are our age or older, probably.
And those, even the grandkids, are dying off. Okay. Yeah. And the great grandkids know nothing about it. Never went there. It was probably already rented to a non-relative by the time they were old enough to know. Those people will sell the farms. And these aggregated pools of capital will be buying from those sorts of investors. And again, to the point I made at the beginning, I don't think that changes in a cultural way what's going on in rural and small town America, because that 40-ish, 50-ish% of farmland is still owned by the farmer themselves. It's just a different kind of investor.
Yeah. So that's the other one. Then I have to hear it. And, somebody will text me and say, hey, this institutional money is coming in here. It makes it so that the small farmer can't buy this. And I'm like, well, I'm not sure that's accurate. That's not been my experience. And you already alluded to it once. So that sounds like it's a gripe or a poor them kind of thing, but it doesn't seem, the numbers don't ferret that out.
No, the facts just do not support that narrative. It's to be honest, nonsense.
Paul, what's the number percentage of farmland that's still owned by the farming entity? It's about more than half.
Certainly. So 30 to 40% would be my estimation. I don't know the fact off the top of my head, but it's that kind of range. And that, as I said, that range has been consistent now for 50 plus years. And what drives that, and the reason it doesn't look, the person that's making it hard for the small farmer to expand is the successful farmer, because he has capital. He will deploy his capital to expand and grow his operation. I don't think we want to stop that. And the natural course of things are, in any industry, the gradually more successful growing operations are making it harder for the smaller, less successful operations to grow. But that's the story of grocery stores. That's the story of small and that's
our listeners.
I don't know how you fix it. I really, look, I have great empathy for that problem. I'm culturally a farmer.
Yeah, right.
But when you start consciously thinking about what do you do?
Yeah.
Well, how do you solve that problem without penalizing the high-performing farmer? That's not fair either.
No, I actually think the same way. And, I'm an ag person but I'm always very honest with our listeners and my audiences about this. I'm like, well, we're supposed to put in some legislation? To be honest, the USDA already props up small and inefficient. If you're large scale, there's caps on what you're allowed to participate in and whatever. So do we want more of that kind of a thing where we say, if you want to be small, the USDA already has a lot of programs like that.
Well, let me give you a statistic that really brings that home. So the USDA tracks something like 2 million farmers. And all you have to do to qualify as a farmer is have the potential of $1,000 a year of sales. I'm sorry, $1,000 a year of sales. That's like your kids' lemonade stand.
Your kids' pumpkin stands, though, by the way.
Yeah, exactly.
This is my desk copy of my book. This book came out. I wrote this. It came out about almost 3.5 years ago, and I talked about
what's the title? I can't read it when you held it up so fast. I got to get it. Food fear. Yeah, because where I was going with this is approximately 120,000 families produce 80% or more of the food in the United States.
Yeah.
We should be so proud of those families, and we shouldn't be penalizing them. We should be cheering them, because what's happened is it lets so many the rest of us go off and work in some new technology industry or medical health, which we all care about, and so on and so forth. So this,
I make those.
You and I are on the same side on this, probably.
And the thing is, it's not because, remember, I was the small guy. I went back and bought, property, and I was that. And I'm sure that a large scale farming operation could have outbid me. Hey, to that point, I just read an article. I live in Arizona half the year. An entity that has 40 car washes, put 2 more in not too far from me. And they're fancy, they're trying to appeal to the kids and they've got colorful stuff and all that. And it's kind of the same thing. Should there be a rule that says you're not allowed to own 40 car washes in a metropolitan area so that the small mom and pop car wash has, and so it's the same kind of thing. I don't think from a regulatory standpoint, I don't want to see a USDA or whoever dictating who's allowed to own farmland. But then I wonder about the China situation. It is true. Last I read a couple weeks ago, China owns about 250,000 acres of farmland, I think was the number I read. And about half of that is tied to their Smithfield, Murphy Brown hog farm situation. Can you speak to that?
Yeah. So before I go to the China thing, just for a second, though, look, the problem of the hollowing out of rural America is a real problem, but that needs to be addressed by not shutting down all the small manufacturing industries, by tax policy in states like Illinois that's driving business out of the state,
right,
in taking all extractive industries and shutting them down. Animal agriculture is the way to increase employment in rural America because it takes way more humans for animal agriculture than grain agriculture. There's an immense number of things that need to be done to keep our small towns and communities vibrant. We're doing none of them. Farmers gradually getting bigger is not the problem. It's all those other things. But now to foreign investment in China in particular. Look, when you're talking about national security, that should trump everything. Yep. That situation up in North Dakota was probably a national security issue, right? There's a key military base. Why are they trying to build a facility right next door? So on and so forth. That's not really an ag land question. If it's national security, it's a relatively short list of true enemies of the United States. They should not be allowed to invest, certainly near military installations. That being said, though, step back from the bigger picture. The amount of foreign ownership of farmland in the United States is immensely small, tiny. I forget what it is, but it's like 1% or less. It's really small.
Right.
And the biggest investors are like the Dutch and the Canadians.
Right.
Well, that's not national security. So we don't want a policy that says, don't come to the United States and invest in one of our most important industries. Mm-hmm. That sounds like a really bad policy. Mm-hmm. We need a very narrow policy that says we should consider whether key enemies should be allowed to invest, particularly not near military installations. But even in that case, let's look at China for just a second. I would argue that if China got 25 or 30% of their food from the United States and owned a bunch of land in the United States, we would have the lever over the Chinese, not the other way around. Mm-hmm. And, I think we're almost thinking about this backwards. The more embedded they are, and it's not like they can take the land. It's not like when they come here and invest in one of our technologies and they could take the technology back to China.
When they steal our intellectual property, it's one thing.
If they got really weird with us, and they got farmland in the United States, that's really simple to say, okay, no exports of that product. I don't care if you own it or not.
Yeah, right. Well, then it becomes the issue like, in Cuba, 1959 with the nationalism, the Hilton and Marriott owned $1 billion of assets there. And all of a sudden, boom, it's just nationalized.
They go to war with us over a major national interest, just nationalize their land. That's a very complicated issue. The bigger picture, though, is you need to separate foreign investment that has some sort of national security issue, clear no. Most of the rest of foreign investment, probably okay.
Yeah.
It's good, good for the industry.
I rent my land to a Dutch dairyman whose family was not Americans when they came over and bought property.
Yeah, exactly. And most of those Dutch are as American as you and I are right now. I mean, they moved their families here.
Yeah, he became a citizen. He's a citizen. And the other thing that you talk about employment and whatnot, there's an economic number that goes with like dairy farms. And a gentleman I know named David Skaggs up in South Dakota, that was his big pitch when they were recruiting dairy farms from California to come to South Dakota. And they said, listen, South Dakota, don't be opposed to this. We look at every one of those cows and they talk about the dollar amount, like $4,000 per dairy cow. That money sticks around here. It goes and buys trucks at your car dealership, and it goes, so you're talking about the economics of all this. usually is good for small towns. The hollowing out of the town of Bippus around the corner for me isn't because of an institutional investor like you, to your point. So I'd agree with that. Last couple of questions. Interest rates. Right now, I'm sitting on some cash, let's say. But if a piece of farm ground comes up for sale in Huntington, Indiana, am I going to buy it? Well, I'm not sitting on quite enough cash to pay cash for a farm. So I'm going to have to lever some money. And then I'm looking at levering what? 8% money. That's going to have an effect on values. Maybe. Will it have an effect on your purchases? You're not using levered money. So what happens in an ascending interest rate environment, which we've not really seen for 20 years? What's that do to this thing on this marketplace?
Yeah. So first, we actually do use a modest amount of leverage in the neighborhood of 30% leverage in our transactions. But good ag lender, just so people listening understand, you ought to be able to find a 6% loan, not an 8% loan. So that'll help a little bit. But you have to shop around for it, but it's out there. But then turning specifically, my advice to most people is that you need to look at the total return to farmland. And based on the numbers I gave you a few minutes ago, that total return's 8 or 9%, not just the 2.5 to 3 you get off of current yield. Mm-hmm. So if you have the liquidity to afford it and have the negative carry on that interest cost for a short period of time, and it's a farm you want, certainly if you're a farmer and it's a farm close to home, go ahead and do it. But don't overstrap yourself. You know how to do a basic financial model about liquidity and downside testing and so on and so forth. So I'm not shy about using a little bit of leverage on a farm that's strategic to you, either as an investor or a farmer. That being said, I said a few months ago, farmers will hold this market high as long as they are reasonably flush with cash from great crop years. And the minute that they are tight again, and that will happen, there won't be high prices and good yields every year forever, you will suddenly see this cost of borrowed money issue show up in the market. And that will either start the price back down gradually, not a falling off the cliff, but back down gradually, or at least a true plateauing of the market. The one thing people don't recognize between strong ag market and weak ag market is there's a huge difference in what is selling. In a strong ag market, the volumes of farms sold is much higher and the quality of farms sold is much higher. In a down market, you have a true collapse in volume. Might be cut in half or more in a down market because no one is selling without death, divorce, or distress. And when they sell for distress, I guarantee you they are not selling their best farm. They are selling their worst farm. Mm-hmm. So this apparent change in value is often driven by the decrease in volume and the decrease in quality in a down market, not apples to apples pricing of similar quality farms. So there's a lot that's going on there and a lot to unpack. But, in our company, for example, the reason we bid aggressively when the market's going up, that's when the best farms are for sale. What appears to be,
by the way, this is our last big point here because it's time to go. But I think that's my favorite point of the whole thing.
It's not one very many people grasp, but it's really important.
And it's something I've known. It's kind of like, I used to be in comedy, and comedy really, a lot of times the comedian points out stuff you kind of knew, but the comedian points it out in a way that you didn't quite see it. And that's why it's like truth is comedy, comedy is truth. And it's Absolutely. Like, son of a bitch, that's exactly right. And that's why I'm laughing. You just said something like, well, yeah, of course, because well-held assets don't usually, if they get distressed, then they're going to say, okay, but we got some turds over here to dump. We're not going to dump our goods.
And what happens in that high market, like we've seen recently, is you're getting people on the sidelines who never thought of selling grandma's farm going, I'm going to let that go now.
Yep.
Back in 2018, they would have never considered selling it because they were going, the price isn't very good.
I love it. I think that's a great point to close out on. His name's Paul Pittman, Farmland Partners. If somebody wants to learn more about what you do, where do they go, Paul?
We're listed on the New York Stock Exchange. Ticker symbol is FPI. And website, if you want to check that out, is farmlandpartners.com, spelled exactly the way it sounds.
I like it. It's a good discussion. If we didn't get to any of your discussion on this is still a hot topic. Send me a message and let me know if you need more on this, because there's a lot of people out here still talking about what farmland values look like, the interest rate effect. We've covered all of it right here. And I think we did a good job. Thanks a lot for being on.
Damian, thank you so much. I enjoyed it.
His name's Paul Pittman, Farmland Partners. Go to farmlandpartners.com. Check it out. Also, go check out TrueTerra. I told you about them, helping you out with your ecosystem management and how you can profit in a new revenue source on farm properties you own in ecosystem marketing. Till next time, I'm Damian Mason, and this is the Business of Agriculture. Well, that concludes another fantastic episode of the Business of Agriculture. This episode was brought to you by Pattern Ag. You know, everybody in agriculture understands the importance of soil health. We also keep an eye on our soil better than we ever did through advanced soil testing. But what if there was a company that provided predictive analytics, not just checking out nutrients and all the elements that are in there, but also could tell you the degree of risk you face with disease and pest pressure? That's right, Pattern Ag can do that. They actually can tell you, hey, you're going to have a real issue here. You can preemptively, proactively treat for corn rootworm or cyst nematode or sudden death syndrome before the problem actually starts costing you yield. Go to pattern.ag, that's www.pattern.ag, to find the nearest rep that can help you start doing better for your soil.